Adjusting Journal Entries. Professor Carol Bruton, Fall of 2014, Accounting 201. Adjusting entries are done on 12/31, a year in, to correct the accounts for the financial statements. They are needed to ensure that revenue recognition and matching principles are followed. There are 4 types of adjusting entries. Type 1 is taking a prepaid expense, a deferred expense, taking an asset and expensing it, such as prepaid insurance, supplies, and depreciation, like debiting supplies expense, crediting supplies. You always debit an expense account and credit an asset account. The second type of adjusting entry is taking an unearned revenue, a deferred revenue, which is taking a liability and recognizing it as revenue, debiting unearned revenue and crediting fees earned. You always debit unearned revenue and credit some type of revenue. The third type is accruing an expense, like salaries expense, interest expense, or rent expense, like debiting salaries expense, crediting salaries payable. You're always debiting expense account and crediting a payable. The fourth type is accruing a revenue, a general revenue, interest, or rent. You're debiting accounts receivable, crediting fees earned. You're always debiting a receivable and crediting a revenue. Here's some examples of some adjusting entries. 1. Taking a prepaid expense like adjusting supplies. On April 1, you buy $1,000 of supplies for cash. On 12/31, you count and there's $300 left. So you need to expense $700 worth. So the original entry when you bought those supplies on 4/1 is to debit supplies and credit cash for $1,000. The adjusting entry required on 12/31 would be to expense $700 worth. So to debit supplies expense and credit supplies $700. Another example is prepaid insurance, adjusting expenses, insurance. On 9/1, say you paid $1,200 for a 1-year insurance policy. The original entry on 9/1 would be to debit prepaid insurance and credit cash $1,200. The adjusting journal entry required on 12/31 would be to debit insurance expense and credit prepaid insurance for $400. $1,200 divided by 12 months would be $100 a month, times 4 months, the months of September, October, November, and December, so you get the amount of $400. Another example would be rent. On 8/1, you pay $1,200 for your rent for the next 12 months. The original entry on 8/1 would be debit prepaid rent, credit cash, $1,200. The adjusting entry on 12/31 would be to debit rent expense, credit prepaid rents for $500. $1,200 divided by 12 months is $100 a month, times 5 months, August, September, October, November, and December, is $500. Another example is prepaid expenses as depreciation. Let's say on January 1st you buy $5,000 equipment for cash that's expected to last 5 years. The original entry would be to debit equipment credit cash. The adjusting entry on 12/31 is to debit depreciation expense for that equipment, $1,000, and credit accumulated depreciation equipment, $1,000. And book value of that equipment would be the cost minus accumulated depreciation.